Namaskaram. In this lecture, we are going to discuss question and answers on transfer pricing. Through these questions, you have to learn transfer pricing. Don't assume that we know transfer pricing and we have to play with the questions. No. Through questions, we have to learn transfer pricing, how the transfer pricing questions can be framed, and how do we reply to those particular questions. Examine the consequences. Okay, look at the words. Examine the consequences that would follow if AO makes adjustment to the arm's length price in international transaction of the assessee resulting in a taxable income. So what is happening, what they are asking, AO is determined to make transfer pricing adjustment, TPA adjustments, and that is going to increase your income. Obviously, when your income is going to go up, your tax liability will also go up, and here assessee will be aggrieved by the action taken by the AO. Look at the word aggrieved. Okay. Whenever assessee is aggrieved by the action taken by the AO, obviously we need to have a remedial actions, possible remedial actions that we have discussed in assessment procedure. You know that assessee can go for rectification, assessee can go for revision, assessee can go for appeal, and here assessee can go in dispute resolution mechanism, which is exclusively created for the assessees who are having an international transaction. And what are the remedies available? So we will have to talk about these disputes and remedies. In the case the AO makes adjustment to the arm's length price in international transaction which results in increase in taxable income of the assessee, the following consequences shall follow. This is the first consequence. You are not going to get any deduction under 10AA or chapter 6A. Your income will go up, but consequently you will not get any deduction. At the same time, you are doing adjustment. If you are doing the adjustment in the seller's book, a buyer's book will not be revised. And if you are doing the adjustment in the buyer's book, a seller books will not be revised, meaning thereby there will be only one side effect which is giving the positive effect. The opposite party which will give us a negative effect, we will ignore that particular adjustment. No corresponding adjustment would be made in the total income of the other associate enterprise in respect of the payment made by the assessee from which tax has been deducted or deductible at source. So whatever TDS was deducted, it will remain same. You are not going to increase or decrease the TDS amount just because of the change in transfer pricing provision on account of increasing total income of the assessee on the basis of arm's length price so computed. The remedies available. So these are the two consequences. Your income will go up, your tax liability will go up, consequently you will not get any deduction. Your corresponding entities will also not get any deduction. Okay. So what are the remedies available? First, assessee can go under section 144C, which is a dispute resolution mechanism, where Commissioner of Income Tax will look into the matter, they will discuss the matter, they will gather the evidence, so many things they will do, and they will try to justify the transaction in respect of the assessee. He can file his objection to the variation made in the income within 30 days of receipt of draft order. So please understand, whenever we talk about the transfer pricing mechanism, the department, income tax department will not directly pass the final order. They will start with the draft order. That's the beauty of DRP. Okay. If you forget the DRP, please watch assessment procedure lectures. You will get the lectures on DRP, dedicated lectures we have recorded. So by him to the DRP, an assessing officer, the appeal against the order of the AO in pursuance of the directions of the dispute resolution panel can be made to the income tax appellate tribunal. If AO makes assessment according to the orders of DRP, because all the DRPs are Commissioner of Income Tax, the appeal cannot lie in front of CIT appeal. The appeal has to go directly to ITAT if assessee is aggrieved by the order passed by the AO on the recommendation of the DRP. In any other case, assessee can file an appeal under section 246A, Commissioner of Appeals, within 30 days, you know that. Assessee can opt to file application for revision under section 264 against Commissioner of Income Tax. So these are some basic remedies that is available for the assessee. The next question, I Limited Indian company supplied billets, some goods to its holding company. Now please understand, whenever India is having subsidiary company and foreign is having holding company, okay, holding company U Limited UK. So this is in UK. Please understand, in India you are having a subsidiary company, in UK you are having a holding company. Obviously these are associate enterprise. Whenever we talk about transfer pricing questions, The first thing that we have to think whether it is a associate enterprise, and the second thing that we should think about whether it is an international transaction or specified domestic transaction. It has to be one of the nature, specified transaction, specified domestic transaction or international transaction. Then only applicability of international transfer pricing mechanism makes sense. Otherwise, it doesn't make sense. So whenever we say subsidiary and holding company, obviously it is more than 26% of the voting power, and therefore they are associate enterprises. Okay. So Indian company supplied means Indian company is a seller to the holding company UK in the previous year. I Limited also supplied the same product to another UK based company V Limited. So okay, one is given to the associate enterprise, another is given to other company which is not an associate enterprise, unrelated party. So you can say this is a CUP method, comparable uncontrolled price method. The transaction with U Limited are priced at euro 500 per metric ton on FOB basis. So this is very, very important data. Here the transactions are valued at FOB basis, free on board. With the custom knowledge, FOB means it is excluding freight and insurance. It's a pure value of the goods. Whereas the transaction with V Limited, transaction with unrelated party, is done at 700 metric ton, but this is CIF value. Okay, now FOB value and CIF value cannot be comparable, because in CIF value FOB plus freight plus insurance. So two more factors are being considered, and they have given us a price of freight and insurance that is 200 per metric ton. Compute the arm's length price for the transaction with U Limited. First of all, which method you will apply? So you will apply CUP method. This is what you should know, because they have given the comparable price. Whenever you are doing the transaction with associate enterprise, you are doing it at 500 euro, and whenever you are doing the transaction with unrelated party, you are doing it 700, meaning thereby prima facie it looks like you are shifting the profit on base erosion and profit shifting from India by 200 per dollar, isn't it? You can see here very clearly that you are charging 200 less to your associate enterprise, and that's what something we have to evaluate. But the point here is that, my dear friend, this is the FOB price and this is the CIF price. Obviously CIF price will be higher than the FOB price, and they have given the data also that CIF price is higher by 200. When it is exactly higher by 200, if I subtract 200 from my comparable price, it will become 500 only. So my arm's length price is actually 500, meaning thereby I am not manipulating. Indian company is not manipulating with this transfer pricing mechanism. Okay, let's look at the answer. How do you present? In this case, Indian company supplied the billets to the foreign holding company U Limited. Since the foreign company U Limited is a holding company of I Limited, I and U Limited are associate enterprises within the meaning of section 92A. You can also write they are holding equity more than 26%. Okay, you can assume. As I Limited supplied the similar products to unrelated party V Limited UK, the transaction between I Limited and V Limited can be considered as a comparable uncontrolled transaction for the purpose of determining arm's length price of the transaction between I and U Limited. Okay, so U Limited by using the CUP method of the determination of arm's length price as applicable under section 92C. Okay. The transaction with U Limited are on FOB basis, whereas with V Limited it is on CIF basis. The difference has to be adjusted before comparing the prices. Now please understand, adjustment we always do with ALP. Okay, we never change the transaction value. You have to keep transaction value intact, untouched. Never touch the transaction value. Always make adjustment in ALP, arm's length price. So the comparable value is 700, but because it is on CIF basis, we have to reduce insurance and freight to make it FOB. If you reduce this, then FOB price becomes, adjusted price becomes 500, and we have also done the transaction at 500. Our transaction value is also 500. Since the sale price of related party U Limited and unrelated party V Limited is the same, the transaction of related party U has been carried out at arm's length price, and therefore no TP adjustment. Please understand. Therefore, there won't be any addition or subtraction, no TP adjustment. Next question. X Limited operating in India is the dealer for goods manufactured by N Limited of Japan. Now, this X is in India, okay, and it is a dealer of Japan, and N Limited Japan must be giving goods to India. N Limited owns 55% shares of X Limited, and out of 7 directors of the company, 4 directors are appointed by them. By them means by N Limited. So you can clearly see these two are associate enterprise. So condition number 1 is complied. And because one of the party is in Japan, you can also say this is an international transaction. So both the condition of activating section 92 are complied, and this transaction has to happen at arm's length price because they are associate enterprises by using the equity criteria. At the same time, more than a half directors of the company are appointed by them. So even management criteria is applicable. The AO, after verification of the international transaction of 300 lakhs of X Limited for the relevant year, and by noticing that the company had failed to maintain the requisite records and had also not obtained the accounts report. Please understand, they have not maintained books of accounts and they have not obtained the report of chartered accountant which is required under 92E, and they have done the default of section 92D. D stands for document. Okay. Adjusted is income by making addition of 30 lakh rupees. So this is TP adjustment. They are increasing the income to the declared income, and also show cause notice to levy various penalties. Obviously penalties will be imposed now. X Limited seeks your expert opinion. First they have done so many defaults. Now they are asking for our expert opinion. Okay. So the fact that indicate X Limited and Y Limited Japan are associate enterprises, since N Limited holds 55% of the shares of X Limited, which is more than 26% of the equity, and has appointed more than half of the board of directors of the X Limited. Since N Limited is a non-resident entity, and any transaction between X Limited and N Limited would fall within the meaning of international transaction under section 92B. Therefore, the income arising from such transaction have to be computed having regard to arm's length price. This is the whole 92 conditions. Para 1 for AE, para 2 for international transaction, and para 3 for arm's length price. The action of the AO in making addition of declared income and issuing the show cause notice to levy the various penalties is correct, since X Limited had committed defaults as listed hereunder in respect of each penalty as briefed hereunder is impossible. So what type of penalty? First of all, if you don't report a reportable transaction, we will consider it as a misreporting of income, and the penalty under section 270A at the rate of 200% of the tax which is payable on misreported income, that much penalty is leviable. Failure to maintain books of account according to section 92D, now the penalty will be leviable under section 271AA at the rate of 2% of the each transaction value. So that is another possible penalty. Failure to get report from a chartered accountant as required by section 92E will attract the penalty under section 271BA to the tune of rupees 1 lakh. The AO shall give an opportunity of being heard. So you have to always mention the PONJ, principle of natural justice. Before levying the penalty, AO has to give you an opportunity of being heard to justify your role in the transaction. The AO shall give an opportunity of being heard to the assessee with a notice as why the arm's length price should not be determined on the basis of material or information or document in the possession of the AO. Note, it is assumed that X Limited has not entered into an APA, advance pricing agreement, and has also not opted for safe harbor rule. So if they opt for safe harbor rule or they have gone for APA, obviously there will be an exception from determination of arm's length price by the AO, but that data is not given in the question. Therefore, this is the by default assumption. Thank you.